Welcome to Theo Trade. This is Don Kaufman. September 22nd, 2021, Fed Day with the S&Ps up some 53 handles. But hey, listen, we are all over the place in today's trading session. We're going to explain right here, right now. Listen, this is why volatility is not going to let up in the near term. So as we're saying, S&Ps are flying to the upside, up about 52 handles right now, just shy of the 4,400 mark. Wouldn't be surprised to actually see us clip back into the 4411 handle. Nevertheless, let's get right down to business. So as I was saying, FOMC, Jerome Powell hit the main stage, caused a little bit of a short-term panic and volatility. But nevertheless, though, the marketplace was up prior to Jerome Powell, and maybe rightfully so, because what we've seen in the last couple of trading sessions, some pretty tumultuous volatility, right? We haven't had much of a bounce. This is it, and thus far, this is it. And I'll tell you what, the S&Ps, this bounce is fairly meager at, just over 1%. The NASDAQ is absolutely lagging, but I'm going to discuss that here in a moment. There are a few factors that really kind of lend themselves to why some of the volatility is going to be here in the near term. One of the number one factors is everybody is discussing China and the possibility, of course, of default. Well, most of that and most of those fears were, I should say, somewhat relinquished last night. And in fact, I'm displaying that on the screen right here, right now. This is where, again, they said they were going to make payment in yuan. The default is probably at least staved off here in the near term. The marketplace popped, and it was a fairly significant pop. Nevertheless, one of the things that you have to recognize is, again, the China factor has been largely pulled away from the market in the very near term. That is, I don't think we're going to have to necessarily worry about the default here in the near term. The next aspect that should really resonate with you is, of course, the FOMC. They too have been largely kind of taken out of the equation, but I got to tell you, following some of the commentary from Jerome Powell and the Fed, I got a lot more questions than I got answers for. One of which has to do with the bonds, and I want to actually start here, okay, of why we feel, again, there is a tremendous amount of indecision in the broader marketplace right now. And I think nothing displays that more effectively than looking at the bond market. So the bond market, which lately has had some just rocking volume, and we have kind of had a very, very mild trend, if you will, to the upside. This is nothing considerably here. Now, as you start to see more upside in the bonds, of course, what does that do to the interest rate? Takes it down. This happens to be none other than the 10-year, though. And if you look at the 10-year, where's the interest rate? Massively unchanged as of recently. The indecision, okay, it's everywhere. Again, you just had, really, in the last 24 hours, right? China came out. They're actually going to stave off this default. That should be wildly positive for the marketplace, because that was the assumption on Monday, that the marketplace sold off based on, China. Number two, the FOMC comes out. They also relinquished a lot of the indecision. Yes, we're on a rally right now. As I said, though, it's very, very minimal and tentative, to say the least. And volatility is backing off over here, but you expect volatility to back off. You just went through two major announcements, again, in the last 24 hours of trade. But again, the indecision, it just looms large inside of the bond and note market. And again, any flinch inside of this debt market, again, the bonds, the notes, can really send the S&Ps spiraling out of control. Another aspect, so I wanted to cover just a little bit about the bonds. And again, all I see in the bonds at this point is indecision. And I'm right there with it. I'm not even selling premium necessarily in the bonds right now, because I'll be very frank with you, there's no feel. There's no feel. And when there's absolutely no feel, listen, if the bonds continue to rally back up, maybe that's duck and cover. That's actually going to crush some of the financials. And the financials, they got their feet back under them a little bit today, but this is a highly damaged sector at this point in the game. All right, so let's push aside the bonds for a second. The assumption, again, the bonds themselves likely to create some short-term volatility. Next on the docket over here, the dollar. The dollar, in my opinion, okay, is more like the VIX than it's ever been before. You're buying dollar, it means you're scared somewhere else in the world. And I got to tell you right now, they are buying dollar. This was rocking dollar movement, okay, right at the midst of the FOMC announcement. Like if you're looking at the FOMC announcement, you're watching the S&Ps, right? Here's the S&Ps, the FOMC announcement comes out, it sold off and it rallied and it laughed and it cried, and maybe we're going to sell off a little bit over here, but net, just take a look, from prior to the FOMC to right now, the S&Ps have moved 5 handles. Like literally, the S&Ps right up into the FOMC time frame is right here. We were trading at 43.85. We're trading in the 43.90 handle right now. So this 5 movement, 5 points of upward momentum through all of this volatility. The dollar, now the dollar doesn't necessarily feel that way. The dollar, okay, sold off and just exploded back to the upside. But the dollar is extraordinarily close to a breakout to the upside. I view this purely as risk. And again, if you look at the dollar in the very near term, you look at the dollar, you're like, oh, okay, it could break out to the upside. But when you start to look at like the last 3 years, all you have to say is, behold, the dollar could explode. And you're going to know it if it starts getting through 94. Okay, that is indicative of, where are you going to go? If the risk really hits the fan out there in the marketplace, where are you going to go? Huh? You're going to drop capital where? Over to the yuan? Of course not. You're going to throw some capital over into the euro? No. Okay, nobody's going into the Russian ruble either. They're coming to the dollar. And the dollar is going to be critical to watch, right in the near future. Again, the dollar breaking back to the upside on the FOMC announcement. I just do not have a warm and fuzzy feeling about this one. Again, some very short-term dollar volatility. Pay very close attention to it. All right, so a bit of a dollar breakout is possible. Next on the docket here of why we're going to continue to see volatility in the marketplace, high correlation coefficients. The S&Ps, okay, and really everything in the S&P 100 is moving in relative tandem. Now, the advanced decline line here has been a little bit damaged. It's been a little bit damaged, but net, we've actually seen to the upside, almost 90 stocks trading to the upside throughout the course of the day. And in some big down movement, I mean, there was a point in time, in some recent sell side activity, you had every single stock down inside of the S&P 100, even stocks that had positive news. It didn't matter, nowhere to go to, nowhere to hide. As long as the correlation coefficient remains high on a relative basis. And what is high? I'll tell you right now, this is high. When you're 80-20, that's a really high correlation coefficient. That's going to keep this marketplace rocking back and forth, right? When you start getting 50-50 slop fests out there is when the marketplace starts to channel in a tighter range. People, this is indicative of overall movement. Again, one of the factors why we're going to continue to see us move. So correlation coefficient. We talked about the China default. We talked a little bit about the Fed. Last but definitely not least, okay, there is a bit of an odd stock out today. And the odd stock out is none other than Facebook. Now, in an overall broader discussion of why market volatility is not going to let up, maybe we wouldn't normally bring in a discussion of Facebook, okay? But Facebook is one of the pivotal underlyings inside of today's trade, okay, to where it really is damaging the NASDAQ, all right, to some degree. So Facebook is down, and if you're kind of curious as to why they're down, it has to do with Apple. iOS 15 has really limited Facebook in a very large way in their advertising. Okay, push all of that aside. The bottom line is stock's down about 3.6%. The rally inside of the NASDAQ would have been far more significant if Facebook was not part of this kind of negative equation in here. But as I've mentioned, kind of day in and day out recently, if you take a look specifically at Facebook, let's go back, drop over to Facebook, look at it in a year-to-date percentage. Facebook just a few days ago was actually up 42%. It is now only up 28% on a year-to-date basis. Okay, further damage and further, again, erosion under Facebook is enough to actually start to impact the broader NASDAQ. And again, you're seeing the effects of that today. Typically in a wild up day, the NASDAQ shouldn't just perform at par, if you will, with the S&Ps. It should be blowing through the S&Ps. I mean, the NASDAQ has, affectionately a higher volatility. So here, again, some damage is being inflicted. In the days to come, unquestionably, once again, you got to be watching Microsoft. It is unscathed in everything that we've seen. All right, and all the volatility we've been thrown at, Microsoft relatively unfazed in here. Taking a look at NVIDIA, relatively, again, unscathed. Last but not least on that docket over there, Facebook. These are, again, the players in the NASDAQ, but their implications are not just to the NASDAQ, it's going to be to the broader market over there. Listen, in the days, okay, that are going to come, just the remainder of this week, keep in mind a couple of very key points. We started this week inside of the SPX, trading right around 40, again, 44.33. We dropped outside the lower edge of the expected move, a $95 expected move. Okay, so the lower edge of that expected move resides specifically at 43, about 38. Nevertheless, we've already checked one major box. We hit the lower edge of the expected move. We anticipate that the remainder of this week is going to be a complete and total free-for-all. There's gamma risk, but it's scattered everywhere, and it's going to make trade, generally speaking, fast, okay, almost like broken feeling, into which, again, at this point in time, we're taking this as a bid back under the marketplace. However, okay, if we start fading in the S&Ps, look for us to touch back down. Again, touch back down to the lower edge of that expected move as the week comes to a conclusion. One last kind of little inkling I want to add to that here is if you do look at the SPX, it's worthwhile and very notable, okay, as you look out even into next week, we are still facing some big boy volatility. Now, granted, there's a whole lot of time between now, of course, and next week, but we're still looking at north of like $100 expected move coming into next week. Again, volatility, people, it appears to be here to stay. You can see, as I've actually recorded here, 10 minutes to go to the cash close. S&Ps are fading right now. Volatility, once again, starting to pick up. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.